Again, thanks for giving us this time. It's a lovely Thursday morning on a holiday shortened week for many folks. Some people are traveling, other folks are, tuned in eating lunch. We do appreciate the time you spend with us. It's valuable. You've probably been getting market updates from different sources over the last month or so. Hopefully, we'll do a really good job of filtering the facts here. We figure we'll be an hour or so of the meeting, probably 45 to 50 minutes on the slides themselves, open up to Q&A. We'd love you to participate. If you want to go ahead and put your question in the chat, we'll address them at the end. So again, just a quick background of Breakwater. We've been in the business for just under 3 years. We manage over 800 million in assets for about 300 families across 25 states, 4 different countries. We have an office in Denver where Madeline is today, an office outside of Boston where Tom joins us, and then I'm here in Northern New Jersey. Again, the conversation today hopefully will be pretty robust. We have a number of sources. Again, I won't go through them one by one, but we're fortunate to get a lot of really good content. I'm going to turn over to Maddie. Maddie's going to kick us off today. Actually, excuse me, before I do that, let me give you the kind of quick talking points here. In 2025. So we had the inauguration 90 days or so ago. Again, change of guard is always one that entails a little bit of an adjustment. But that being said, I think it's been a bigger adjustment than perhaps most of us thought. DeepSeek was a big announcement as the Chinese have kind of caught up, or maybe are using some technology that's already out there, but has kind of changed the narrative that relates to AI. So that's something that to be watching. We had the markets at all-time high back in the middle of February. Seems like an eternity ago. But again, we have seen a pretty good run in the last couple of years, and not a great start here in the first kind of 4 months or so of 2025. Bonds and overseas equities have done quite well by comparison. It's interesting. If I looked at this same report last quarter, almost all the stuff that looks great now didn't look all that great then. So it's just a lot about mean regression, or the importance about maintaining a long view. We'll get more into why overseas stocks did well, but valuations, combination of monetary and fiscal stimulus seem to be pretty supportive of the make everyone else great again movement, which is surely happening with Trump kind of putting the screws to folks in Europe and elsewhere. Labor markets continue to be pretty robust, which is a good sign. It's somewhat helpful in the face of some other uncertainty out there in the broader economy. But again, Maddie will take us through that in a little bit more detail. And here we are in the midst of earnings season. We've heard really at this point just from a few companies, really it's the banks who had a really blockbuster first quarter. Some of that was in the back of the trading volatility, or trading around the volatility. But again, first quarter earnings should be okay, right? We're probably looking at high single digits, and the expectations for the year are still relatively high, right around 10%. They've come down from 14, but if we can see earnings growth this year, stocks should have some support. And then obviously it's all about tariffs. We'll kind of wrap the discussion on that. But again, Maddie, let me turn it over to you, and you can take us through some of the macro.
Awesome. All right. Well, first we want to start with, as we always do, we want to take a pulse check on GDP growth. So this slide here looks at the different components of GDP growth over the past few quarters here. And so looking at the broader macroeconomic picture in Q4, again, we always want to, give a reminder that GDP is a backwards look or a lagging indicator. But if we look at Q4, the U.S. economy continued to slow when looking at GDP, with real GDP growth at an annualized rate of 2.4%. You can see there on that last bar graph, slight improvement from the average GDP going from 2000 to 2024 of 2.2%. If we look at consumption, that always remains the key driver of growth. Consumer spending contributing 2.7%. Certainly, if we look at that, that's well above its long-term average of 1.7%. So we still see a pretty relatively strong consumer. We also see a positive contribution from government spending and net exports, while residential investment added modestly, as we continue to see the housing activity starting to stabilize with the Federal Reserve's rate cuts from last year. If we look at what dragged GDP down, we see business fixed investment, which subtracted 0.4% from growth, and inventories, which pulled down by almost 1% at 0.8, indicating that businesses may be working through excess stock as they were anticipating some tariffs in the new year here from the Trump administration. Overall, after looking at this slide, you can see that data reflects still resilient consumer, tempered business investment, and a normalization in inventory levels. The balanced growth profile set the stage for continued but slower economic momentum probably in the coming quarters here. And then if we check in on unemployment and wages, we show this slide a lot, but I think it's a pretty important one because the unemployment rate, will set the tone for a lot moving forward. So if we take a pulse check for the end of Q1 here, we're seeing the continued resilience in the labor market, as Jeff had pointed out earlier. Those signs of some normalization are becoming more apparent here. The unemployment rate in February held steady at 4.1%. Still well below the long-term 50-year average of 6.1% that you can see there in the gray. This suggests the job market remains relatively strong despite some softening across sectors like tech and manufacturing, probably not too big of a surprise. I know Jeff will get into that on the equity side. And on the wage side, we see year-over-year wage growth cooled meaningfully from its March of 2022 high of 7%, where we saw inflation at its highest as well, now sitting at 4.1%, certainly almost exactly in line with the historical wage growth averages of 3.9%. So the deceleration in wage growth is a welcome sign, certainly for the Fed, as it works to manage the inflation pressures without tipping the economy into a deeper slowdown. So overall, this chart underscores the rebalancing that's certainly underway in the labor market, cooling, but certainly not collapsing. And if we want to look at that a little bit further, we want to check in on labor demand. On the left-hand side, you can see that the job openings as tracked by the JOLT survey continued to trend downward, falling from their 2022 highs, now sitting closer to pre-pandemic levels, so really normalizing out there. And if we look at the labor market, remains tight by historical standards, but employers have clearly been pulling back on new hiring. And if at the same time we look at job cut announcements spiked in Q1, shown in the bottom left panel, certainly largely driven by federal job cuts, which has also been in the news a lot. Despite that, we're not seeing widespread layoffs across the private sector, which is a good thing. But if we look at that, we can see that the private sector is suggesting that we're still in a low hiring, low firing environment. And on the right, you see non-farm payroll growth has slowed as well. Monthly job gains have settled into a lower, steadier pace, another sign that the labor market is cooling, but not yet cracking, and the 3-month moving average remains positive, though well below the robust levels we saw of 2021 and 2022. Overall, cracks are emerging, especially in government employment, but probably no surprise there with DOGE, and the private labor market is still holding up definitely reasonably well here. If we look at how the labor market and employment affects the consumer, which drives, as you saw in the beginning, a large part of GDP, one of the key drivers of economic growth certainly has been the consumer. But as you can see on this slide, the underlying dynamics are starting to shift. On the left, we see the household debt service ratio, which measures debt payments as a percentage of disposable income. This ratio remains below pre-recession levels, but it has been trending upward as interest rates and consumer borrowing rise. On the right, we see a more concerning trend. Serious delinquency rates have been trending upwards, especially for credit cards and auto loans. Certainly on the rise, you can see there in that lift. Credit card delinquencies are now at their highest level since the aftermath of the Great Financial Crisis. Student loan delinquencies have also ticked up a bit, especially after the restart of federal loan payments. So what this tells us is that consumers certainly have been resilient, but they're relying more increasingly on credit card to maintain spending. And with savings rates low and delinquencies rising, there could be more and more pressure on the consumer-driven growth in the quarters ahead that we've seen in the past year. And now if we take a look at how that affects business confidence and consumer confidence, this slide highlights some of the hesitations we're seeing from both businesses and consumers as we take a look further into 2025. On the left, we see small business capital spending plans, which have pulled back sharply over the past year. This reflected both in the NFIB survey and the actual private non-residential investment numbers. Much of this hesitation appears to be driven by ongoing uncertainty around trade policy and tighter financial conditions. On the right, we check in on consumer confidence, which is measured by the Conference Board. That's stabilized but remained well below pre-pandemic levels. Retail sales, excluding autos, have been choppy to start the year, but much of that volatility may be tied to seasonal factors like weather patterns that we've seen here for the winter. The takeaway is that while we're not seeing a collapse in confidence, both businesses and consumer sentiment are clearly more cautious, potentially signaling slower momentum in the economic growth in the near term. And if we take a look at the federal finance budget, this slide gives us a snapshot of the 2025 federal budget and the broader trajectory of U.S. government finances. On the left, we see total government spending is projected to hit $7 trillion in 2025, with some of the largest components being Social Security, Medicare, and the interest on national debt payments. The national debt payments are now totaling nearly $1 trillion or 14% of spending. The deficit is expected to be almost $2 trillion, meaning over a quarter of the federal budget is financed with borrowed money. So it's something that's continued to be in political discourse as well. But moving to the top right, we see how the federal deficit and net interest costs have evolved as a percentage of GDP. The gray bars that you see show the total deficit, while the blue bars isolate interest expenses. Both of those things are projected to increase, especially if the Tax Cuts and Jobs Act is extended beyond 2025, which would further widen the fiscal gap, as you can see there. And then on the bottom, we check in on the accumulated impact of the deficits, as shown in net debt, as a share of GDP is projected to climb from about 98% in 2024 to over 130% by 2035 if the Tax Cuts and Jobs Acts are extended and spending continues at its current level. Big takeaway here, federal finances may be on an unsustainable path driven by the rising costs of Social Security, Medicare, higher interest payments, certainly, and persistent deficits. So this will likely remain a key macro risk for markets over the long term, especially if rates stay elevated, and certainly a continued theme that we're going to hear about in the news. And then, of course, you may have heard a thing or two about tariffs this past quarter, but certainly something that we wanted to address here. We showed this slide last time as well, but I think it's interesting how it evolves over time. So we're looking at a historical trajectory of U.S. import tariffs, highlighting certainly a significant change in recent months. In early 2025, the Trump administration implemented a series of aggressive tariff measures. We've all heard about the Chinese tariff measures increased to 145%, with some trade-offs there. Canada and Mexico, a 25% tariff was imposed on imports, citing national security concerns. And then we also hear about all the other global reciprocal tariffs, some going up to 35%, like in Vietnam, and 20% on the European Union. So if we look at these actions have effectively, sort of ended decades of trade liberalization, leading to probably increased costs for U.S. consumers and businesses, possible supply chain disruptions, and heightened global economic uncertainty. The Fed has expressed caution relating to tariffs, indicating a pause on interest rate changes until the economic impacts of these tariffs become clearer as time goes on here in 2025. And, if we look at the big takeaway, tariffs were once a declining feature of the U.S. trade policy, as you can see there from 1930 to this year. But recent measures have reversed, this trend, making a new era of protectionism with far-reaching implications that it may have on the global economy. More to come in the coming quarters here. And if we take a look at inflation, because tariffs, will probably drive up inflation, we wanted to make sure to show you the inflation chart that we've been showing in the past quarters, and it's changed a bit. This breaks down the components driving headline CPI over time, and this is as of the end of February. We're seeing clear signs of disinflation, which is a good thing. You see that headline CPI has eased to 2.8%, down from 9.1% at the peak of June of 2022. And now it's below the long-term 50-year average of 3.7% core CPI, which strips out food and energy. That's also cooled to 3.1%. And the bars here on this graph show the contribution of different components to overall inflation. And so you can see that recently we've seen a decline in energy and food inflation. Of course, the bird flu has sucked up all the oxygen in regards to egg prices, but other food costs have come down, which were major drivers during the post-COVID surge. And we still see that shelter remains a sticky contributor. Auto insurance has emerged as a persistent pressure point, now contributing to inflation more than it did at the height of the inflation spike. So I would say overall this trend is really encouraging, but inflation hasn't fully normalized, with core services still being elevated. We're likely to see that the Fed remains cautious before making any more significant rate moves. And we can see that the inflation story has improved, but some underlying pressures, especially in housing and insurance, still lingering here. And then we want to check in on trade and immigration. As we talk about inflation, the slide ties together two key macro drivers that are front and center in 2025, trade and immigration policy. On the left, we see U.S. Top trading partners in 2024. Mexico leads, followed closely by China and Canada. These three alone account for well over $1 trillion in imports, making them highly vulnerable to the wave of tariffs announced by the Trump administration. With sweeping tariff hikes on China and now broad-based tariffs on Canada and Mexico, we're already starting to see ripple effects in the global supply chains and U.S. import costs. The right-hand chart shows why immigration policy is just as critical. Historically, there's been a strong correlation between labor force growth and GDP growth over 5-year periods. And recent proposals to restrict immigration and accelerate deportations could put some downward pressure on the size of the U.S. labor force, which in turn weaken longer-term economic output. So if we put these two things together, these two policy levers, trade and immigration, are now some of the most important macro variables to watch as we move forward into the year, and the direction they take will likely have a major influence on inflation, growth, and the federal policy moving forward. If we take a look at productivity growth, this slide focuses on U.S. labor productivity and evolving role of AI driving future gains, which I thought was interesting. AI has been in the discourse a lot, so wanted to put a slide in there about it. On the left, we're looking at the 5-year annualized rate of non-farm labor productivity. And after years of sluggish growth, productivity picked up following the pandemic, reaching over 2% annually. Certainly a positive sign, but still below peak levels seen back in the early 2000s. And then if we look on the right-hand chart, it becomes especially relevant. It shows the percentage of businesses using AI to produce goods and services with data from both September 2023 and March of 2025. If we look at sectors like information, professional technical services, and education service are leading the way in AI adoption. Encouragingly, the striped bars indicate that adoption is expected to expand pretty meaningfully across the most industries over the next 6 months, including real estate and finance. And while productivity growth remains uneven, the increased adoption of AI has the potential to be certainly a game changer over the coming years, unlocking possible efficiency gains, reducing costs, and potentially boosting long-term economic output. And the key, I think, will be how broadly and effectively businesses can implement it. And then for our last side here on economic data expectations, this chart I thought was also really interesting. It shows the Citi Economic Surprise Index, which measures how actual economic data compares to market expectations. Readings above 0 indicate that the data is coming in better than expected. And what really stands out here is that in early 2005, Europe has significantly outpaced the US in terms of the economic surprise. The light blue line represents the euro area, which has been trending solidly positive, while the dark blue line represents the US, has hovered closer to 0 or dipped into negative territory. And that could mean that while the US economy is certainly still growing, the data has been coming in weaker than expected, whereas the European data has been consistently exceeding forecasts. So the divergence is important, not just for economic outlooks, but also for the markets. And that's seen in the divergence in how those two asset classes have performed. And if we look at historically better than expected data trends to correlate with stronger equity performance, and that's something that we're definitely starting to see reflected in the strength in European markets. So with that, I will kick it over to Jeff to cover US equities.
Thanks, Maddie. That's great. Appreciate it. Ton of stuff to digest there. We'll come back and talk to a couple of those key points around debt and tariffs as we wrap the meeting up today. Just again, I know when I usually go through the slides or eye charts, you'll see a slightly different format today, with the idea of being it's legible, right, first and foremost, and more digestible, right? So hopefully the takeaway will be that you were able to absorb more of the information. I will try my best to speak a little bit more slowly as well. So you can see in the first quarter, despite the fact in February we hit all-time highs, I think the market was up around 4 or 5%. We ended the quarter down around 4.5%. But it's really only 4 sectors that were ended in the red. The reality that those 3 of those sectors are really big, right? Consumer discretionary, which is where you'll find Amazon and Tesla, was the laggard of the bunch. IT, which is where you're going to find Nvidia and Microsoft and Apple. Communication services, where you'll find Meta and Alphabet. And then industrials, which were, let's call it flat. But you saw, again, 6, 7 of the other sectors firmly in the black the first quarter. So again, it speaks to the diversification story. So again, kind of a bit of a flip-flop on what we saw in 2024, where all things in the Mag 7 world were doing quite well. Maddie, I'll have you up to the next slide. To get into the particulars a little bit further on this, kind of zoom out, I look at this in the first quarter and I see a lot of green. It's a heat map of all the constituents of the S&P, and you can see some of those bigger squares or rectangles, right? Nvidia down 20, Amazon down 13, Alphabet down 18. Because of the size they have in the marketplace, they had a bigger influence on the index. But on a absolute level, right, more stocks went up than down in the first quarter, which is encouraging. That's kind of that breadth story. Again, Tesla up there in the right-hand corner, down 35%, was surely a big source of drag on the broader market. We'll hop to the next slide. The points I want to bring out here as it relates to kind of the return story was evident in the first quarter is really coincides a lot with the valuations, right? If you look at the stocks or sectors that did well, energy, materials, financials, right, kind of moving from left to right, those are some of the cheapest out there relative to looking at the forward multiple, right? Trading at 15 or 16 times. Look at both energy and financials, whereas the broader market, which is way on the far right side, trades at a forward multiple around today, call it 20. After the further sell-off we saw in stocks in April, the S&P is probably around 19 times. So less demanding for sure. I would prefer to have got there because earnings grew faster than price, but it was a circumstance where price has corrected pretty quickly. But again, I think this theme about valuation is important. And as we continue to think about the years ahead, a better starting point from the standpoint of valuation, all else being equal, oftentimes will translate to some better returns. There's some other interesting pieces here as you go further down the page, the buyback yield, which is the propensity of companies in those sectors to buy back stock. You can see that's quite robust in the technology space, but most sectors or most companies are pretty active in reducing their float. And then the dividend yield, I think this is an important point. The S&P yields about 1.7% below its long-run average, but you can find dividends in sectors like real estate, healthcare, energy, and to some extent consumer staples as well. We'll get into total return a little bit later, but I thought this was just a nice slide to kind of look at everything from a individual constituent perspective. Matt, I'll have you hop to the next slide. As I was alluded to before, valuation matters, right? Again, on a forward multiple, the S&P at 19 times puts it about, roughly speaking, 8% above its 30-year average, which is closer to about 17 times. Now, again, some of that can be explained by really strong performance in the post-pandemic period. Some of it can be explained by a kind of new paradigm where a lot of companies are intangible, and by being comprised of more tangible assets, goodwill, network effect, and as a result, they might trade at a higher multiple than the big companies that made up the indices years and years ago, who owned a lot of equipment or land, kind of what we describe as hard assets, or things that were a bit more contributed book value. But again, as you look at the valuation today, no one's going to be able to tell me with a straight face that we're looking at a cheap market, even though we've had a decent sized pullback here. Matt, I'll hop to the next slide. Just to get into that combination, the conversation about earnings growth this year, are coming into the fourth quarter, right? Which you're kind of looking out to all of 2025. The kind of consensus estimates from analysts was 14% growth in 2025. Since that period of time, it's been revised somewhat lower. We're now talking about something closer to about 11%, although again, more recently, I've even heard down at 10%. First quarter earnings are projected to be around 7% as you come into earnings season, but companies have been beating those earnings estimates pretty consistently by about 6% or so. So again, I wouldn't be surprised if we saw double-digit earnings growth in the first quarter, which is a good story. The question, however, is really where's guidance, right? What are we going to hear from companies about Q2, Q3, Q4, where if there is a concern about their business and that impacts earnings growth, it could be something that results in either stocks trading in a range or in a worst case scenario, trading a bit lower. The source of that earnings per share growth has largely been on the back of margin improvement, right? Now, again, margin improvement could be through AI or productivity. It could be through synergies or acquisitions, or taking out competitors, although we haven't seen a lot of M&A activity the last couple of years. And then the share count, right? Like, again, reducing the amount of shares outstanding. The idea that margins can meaningfully expand in a world where labor markets are still relatively tight and tariffs might be a more challenging piece to navigate creates a little bit of a headwind in the near term. It's impossible to argue against that. Again, I think as we have been around this business for 25 years or so, whether it's the financial crisis or it's the pandemic, I don't want to bet against the U.S. companies and their capacity to be very thoughtful of how they manage their income statement. So while there could be some near-term margin pressure, my expectations are that margins will continue to stay healthy. If you look on the right-hand side, you can see kind of long-run average margins, 10, 12%. Here we're up around 13. Even when we got that back down to 10 or 11, it's still, again, quite healthy from in a historic context. Maddie, I'll be hop to the next slide. Again, this is what I was talking about a little before with earnings, buybacks, and dividend yields. Again, when you think about your investment, it's great to have it come all in price, but in a number of sectors, we see a combination of price appreciation, a healthy dividend, and the company buying back stock. If you look at the buyback yield, which is on the left-hand side, the combination of buying back itself and the dividend, energy stocks have a capital return of roughly about 7%. This is before any sort of price change. So that gives you a decent baseline. And you're seeing, again, as you move from left to right, those numbers are still healthy, 3+% or so. So if you get something resembling revenue growth and kind of your traditional earnings growth on top of the shareholder yield, you can still see equity returns in high single digits, in some instances, even low double digits. Again, I think this is kind of an interesting way of thinking about it. It's not all about price return. A lot of it is about the companies being thoughtful of how they deploy capital. And in a world of uncertainty, I think you're going to see a lot more buybacks over the course of the next 12, 18 months as we navigate the tariff landscape. How much of this is a negotiating tactic? How much of this is the new normal? How much of this will be kind of addressed through rerouting supply chains, or how much of this will be done through onshoring? Maddie, I'll have you go to the next slide. Again, before, you may recall, there was a fairly busy slide, so we've kind of used the executive summary version. You can see Q1 value outperformed, right, kind of across the board, although small cap value was a bit in the red. That was some concerns about the smaller banks. Again, Q4, right, it was kind of like the inverse of that, right? So again, this is the idea of why diversification matters, or mean regression. But then on a 1-year basis, right, in spite of the fact that we're all licking our wounds on how we've done in the last couple months, the fact is, we've seen actually pretty solid returns across the board, and values actually outperform growth. And again, I think that theme might have some lags, right? The Mag 7 has become the Lag 7. So hopefully, if you have exposure in some of the names that are outside of technology, communication services, and consumer discretionary, you've fared a bit better here in early 2025. Let me go to the next page. Again, this is why we make the case that value matters. And again, we're a relative value company, right? Like, our philosophy is not that we just dogmatically want to own stuff that is in the consumer staples, utilities, energy, and financial space, right? We firmly believe you have to own everything, but you can have overweights or biases based on kind of market conditions. So if you look at the side of the left, right, when the line is below the perforated the long-term average, it's generally not a bad time to own value. And when it's lines above that, it's generally not a bad time to own growth stocks, right? So again, today we can see that on a comparative basis, value stocks still in a both relative and absolute basis make more sense for every incremental new dollar to invest, or perhaps shifting some money from growth versus value after significant outperformance for the last 15 years. Again, lower left, you can see the valuation on a forward multiple for value is 16 times, right? It's probably now closer to 15 times, very close to its long-term average. Growth is probably now closer to 22 times, close to its long-term average, but again, roughly 25, 30% more expensive than value stocks. And if you are getting into a slow growth world, or a world with more uncertainty, the paying more for something to me seems to be a little bit of a leap of faith. And again, on the right side, earnings per share growth. Earnings per share growth was like remarkably higher for growth stocks, right? 14, 18, 15% in 23, 24, and projected in 25. But the gap is narrowing, right? It was a 10% delta, 18% delta in 23, a 6% delta in 2024, and what's going to be a 6% delta likely here in 2025. So it's rate of change that matters as much as earnings growth itself, right? And so that rate of change being positive, is perhaps something, again, to look at on the value side as a reason to be a little bit more constructive there. I'll skip the bottom slide. It's pretty straightforward, but the idea is that there's a case to be made that value should be a healthy representation of the portfolio as well. Maddie, I'll have you hop to the next slide. Again, this is the head scratcher for me. Truthfully, like, we have a fair amount of exposure in small cap stocks. I say fair, nothing compared to what we have in larger companies, but small cap stocks should see pretty significant earnings growth this year, right? In the lower right hand corner, you see a number that's maybe in the 30s or 40s. They've been much maligned, mainly on the back of their perceived to be particularly sensitive to tariffs or trade issues. They have less pricing power, less leverage with procurement and their producers. And at the same time, if the economy does slow down, they're more susceptible to the business cycle as being more levered. It's kind of either or, right? I don't know how it can be both, but the truth is, to me, like, there's enough value there that you want to own some, right? Again, they might be 4 or 5% of our client portfolio, so it's not huge, but I do expect, again, a little bit of spring back effect. You can see small cap stocks performed very well after the tech bubble, the financial crisis, or after COVID, when they were kind of left for dead. And again, I see similarities today to that. When I hop to the next slide, Maddie, as well. This is, I think, pretty telling in why a lot of client conversations we've had over the last, call it 6 weeks or so, have been one where I hear recurring, that people are exhausted, right? That's kind of the phrase that's been bandied about. If you look at the last few years, 22, 22, 23, 24, we started with fairly volatile year in 2022. You had the Fed lifting off in a more aggressive way. We had a bear market for stocks. We had a bear market for bonds. And so you see like the dispersion, which is what that those little dot plot is there to show you. And then 23 and 2024 were pretty darn calm. You saw similar years in 2017 and 2019. And here we are in early 2025. Again, like the dispersion is pretty broad, right? Again, could it look like 2020? It could. I don't think it's going to be like quite that crazy, just given the fact, hopefully we don't have another pandemic. But the point being is, volatility does from time to time pop back up, and as it rears its ugly head, at least how it's perceived to be its ugly head, you just have to make sure you have the stomach for that volatility. I don't hear any of the nonsense about, hey, if you can't take it, you shouldn't be in the market. That's garbage. Anyone who says that to you is insulting you. We just want you to acknowledge that, hey, it happens. We have to just kind of lean into it sometimes, even though it might be uncomfortable. And again, by comparison, if you look at last year, 2024, the best day, the market was up 2.5%. Last Wednesday, the market was up 10%, right? It's one of the top 4 or 5 best days for the S&P in the last 50 years. The worst day sounds like a pedestrian Tuesday was the August sell-off, somewhat tied to the Japanese carry trade unwind. But you saw, again, 58% of the days were up days last year, 42% down days. This year, it's actually pretty interesting. It's close to about a 50-50 split. Hasn't been nearly as bad as it might seem after, again, a rough couple of weeks. But the truth is, again, volatility can create opportunity, right? We don't want to, look at volatility as the bug. It's actually a feature of the market. Matt, I'll have to go to the next slide. Just to tie that point together here, these are market pullbacks, right? The pink and yellow, and I don't know if that's magenta. Declan would scold me on the color sheet here, but again, if you go back here in this, roughly 10-year span of time, right? You're looking at a fair amount of periods where we went through some sort of market drawdown, 5, 10, or 15, 20, or 20 plus. And yet the market's kind of path of least resistance was up and to the right. And so that's encouraging to me. And I don't see any reason why, if we zoom out over the next 10 years, the chart might look any different. But let me go back to the corrections concept, and just to go ahead and Matt, the next slide. As you see on the left, right, we have 50 years of S&P corrections. There's one little kind of part in the belly here, which I know seems to suggest that it's not as easy to overcome. But I really look at that. 2 of those years, or 3 of those years, even if you look at the 3 or later chart, are pulling in the post tech wreck 9/11 implosion. So the only other periods that have a 3-year later negative return would be the starting point of October of 2007, which was the peak of the S&P at the time, through the financial crisis, and then those are down 2, right? Like, so again, I look into that, I could tolerate down 2. I wouldn't be happy with that, but it's not going to go ahead and derail my financial plans. But again, even the 1-year later basis of these, I don't have the total number, but let's call it like 25 examples of corrections. Only 5 of them were down, right? And so again, just the importance of maintaining that long-term view. And as we look at the right-hand side, this is basically the post-World War II period. Markets are going to go up about 50% of the time, even in bear markets, right? They're going to go up 54% of the time in bull markets, right? So, to the extent that there's more good than bad, I would tell you, should be optimistic. It doesn't mean, again, this is over, could continue for a while. But again, the truth is, this is not all that atypical, even though the source of it today is different than it was in 2020 or what it was in 2018 or 2008 and so on and so forth. Matt, I'll have to go to the next slide. Switching back to kind of markets, right? Oil, which is something the president has focused a lot on, right? It's kind of interesting is to understand what exactly the end game is. If we are hoping to export more fossil fuels to Europe and the like, ending the war in Ukraine might not be the best strategy, although I still think that makes a lot of sense. But you can see oil prices have directly been headed down. We're actually in the 60s as we talk today. That should spend or trickle into consumer spending in a positive way, right? So, after the March CPI of 2.4%, I'm pretty sure that the Fed would probably be easing in June were it not for the tariffs. But again, we're getting a little bit of a a tailwind from oil, which is a good thing to see, considering it was obviously a source of that inflation back in 2022 and even early in 2023. Maddie, hop to the next slide for me. It's not all about oil when we think about the commodity markets, right? We've heard a lot about copper, which has had a solid start to the year. It's up 10% through the first quarter. And then gold, right? Again, periods periodically, where gold becomes all the rage. Gold's up, something closer to 25% a year, 19% through the first quarter. Why is that? I think a lot of that stems from, what's going on with concerns about global trade, concerns about U.S. debt and frankly debt elsewhere. If the Germans are going to, produce $1 trillion of a stimulus bill, it means the Eurozone is going to see some more debt issuance as well. But again, the world where inflation is still front and center, I think across the board, with the exception of a couple areas, the general trend has been positive on the inflationary story, right? Again, cocoa and chocolate continue to be some indulgences for some folks. Again, I'll pick you on the cocoa side, not so much on the chocolate side. Not looking for any relief there anytime soon. But again, commodities, generally speaking, have calmed down quite a bit from where we were back in just a couple of years ago. I'll close out on crypto. Well, we had a webinar where we had a guest, speaking to crypto, Bitcoin in particular. Again, I know people last week, I got a ton of emails saying, "Oh, like, hey, crypto held up well, and the market sold off." And that's 2 days, Thursday and Friday after Liberation Day. But if you look a little closer, it hasn't been a great story for crypto, which ultimately has traded quite closely to the Nasdaq, right? So again, we are really primarily focusing on traditional assets, but we'll look at everything because it's important to keep ourselves informed when it comes to those client conversations. I'm going to take a break. I'm going to turn it over to Tom. Before I do that, I want to highlight the fact that Tom had the not so great job of just going over international equities and fixed income in the fourth quarter. So he gets the prize today to talk about the good stuff in the early part of 2025. Tom, the floor is yours.
Thanks, Jeff. I wish I could celebrate and say that these aren't diversifying type plays and that this was 75% of everybody's portfolios. But either way, the global equity markets did pretty well in the first quarter. Sorry, really leading the way. Believe it or not, was Hong Kong. Where you see China was down 1%, Hong Kong was actually up 16.1%. The Hang Seng more heavily weighted toward blue chip Chinese companies and benefited from some policy stimulus. Whereas I would say the trade wars really kind of dragged down the CSI 300 a little bit more. We do see a reversal, and I am looking at really the third column where it says 3 months at the top of it. A reversal in Japan, where Japan has actually done really very well. And that's evidenced as you look at the 3-year, the 5-year, even the 10-year numbers for Japan. But over this quarter, Japan was down 9.9%. And ultimately, on the next slide, Matt, if you don't mind flipping over, you start to see the central banks, right? So a lot of times you'll hear things like, don't fight the Fed. That really, it really works wherever you are in the world. When you think of the central banks that are controlling money supply and have the ability to either raise rates to slow down the economy, again, fight inflation, or lower rates to try to stimulate growth. If you look at really the bottom line on the left-hand side, the very, very light blue, that's Japan. They're raising rates. They're trying to get off of zero. They were at zero or even negative rates for years and years and years. Where you look at most of the other central banks, the turquoise, again, Declan might come after me for my colors too, the yellowish orange, the dark blue, and the Bank of England, which is the reddish color. They're all more in accommodative type stances, right? So they're lowering rates. The ECB cut rates again today, not to jump ahead into this next quarter, but they're moving in that direction that would help to stimulate the economies. And again, if you look over the last quarter, you can see that in stock market results. If we look at the next slide, global inflation, right? So when you think of, again, central banks globally, they're looking to combat inflation. They're looking to stimulate their economies, make sure that we're staying away from recession as much as we can. Again, even though a recession traditionally is 6 to 12 months, it's not a huge period of time. It is, often no fun to look at your portfolio. As Jeff said, right now, international and fixed income, I get that honor. We did a little bit better in both of these categories. If you look at the chart on the right-hand side of the global inflation slide here, Russia was at the highest, really, third, fourth quarter in a row, up to 10.1% inflation. Still, obviously, engaged in the Ukraine war, and some of the pressure that the United States is putting on them. India, interestingly, dropped from 5.5 to 3.6 this quarter. China went actually negative, so they're at 0.07. They were just barely positive last quarter at 0.2, but they actually are in the negative territory, which, again, you think tariffs, you think, as we've talked about on these calls often, the demographic decline, the increase in labor costs, and really the debt that China has really just issued time and time again, trying to stimulate their economy and grow their economy. It's an interesting story that we're going to continue to watch. And really, if we jump to the next slide, as we think global equity valuation, so Jeff talked about, PE ratios and where are we, large cap and value versus growth, mid cap, small cap. This is really kind of the international markets, PE ratios versus their long-term average. The MSCI EFA 14.3 versus its 15-year average of 13.8. So it's trading just above that. Really, the last quarter doing so well has pushed those numbers up a little bit. In the emerging markets at 12 versus 11.4. So pretty close to its 15-year average as well. If we do jump to the next slide, a little tariff talk, as that is such a popular topic right now in the world, in the market. I thought it would be a good idea to include it. I don't want to jump too far ahead, as much as I feel like we would all love to leave tariff talk in the last quarter versus this quarter. It probably is going to be something that we're going to be talking about for a quarter or two or three, depending on how things go, right? So generally speaking, Trump seemingly tried to telegraph the fact that he was a fan of tariffs, going to introduce tariffs. But in the end, I think it was the extent that tariffs got introduced that surprised the market, right? And we all saw the reaction where the market dropped significantly. And he's talked about, oh, this is just an acceleration of something that was potentially going to happen already, or maybe it is the AI / Mag 7, Lag 7, as Jeff called them, accelerating those companies coming back down to earth a little bit. It's interesting, if you look at the chart on the left-hand side, it probably was outdated about 2 seconds after they produced it, because tariffs have been such a moving target. But it really is meant to display, if you look at the X and Y axis, is it talking about the tariffs imposed by the United States and then tariffs imposed on the United States. And that was really a big topic for, again, the Trump administration to say, hey, these are the tariffs that we're going to put in place, even in some cases against unpopulated or sparsely populated islands out in the middle of the Pacific Ocean. I do, however, like the chart on the right-hand side, which talks about just exports and really the exposure by country. So if you look at the charcoal color, that's like exporting to the rest of the world. The purple is exporting to the United States, right? So as Maddie had mentioned, if you look at Mexico, China, and Canada, they're our biggest trading partners. Canada, Mexico, the purple meaning the percentage of actual goods that they export, extremely high to the United States. If you look at China, it looks smaller just because they've been the workshop of the world and they've exported, to all parts of the world. But as you do look at just how heavily they are reliant on exports, I think that's where you get, one could argue, a bullish comment from Donald Trump to say, hey, we could essentially annex Canada and it'll become part of the United States if we just tariff the heck out of all of these exports, just because so much does come from the United States. It's at the same time, again, do we want to anger every single trading partner and every single friend that we have in the world? I would argue, no, that's not a good policy, long term, and even we've seen short term. Maddie, if you don't mind jumping to the next slide. I really liked this slide because the left-hand side talks about, the semiconductor production. So semiconductors have been, not just because NVIDIA has done so well over time, but they've been just a hot topic as it relates to AI. And, if you look at the number of countries, the number of companies that actually touch semiconductors, it's massive. And, it talks about production. China's production largely is lower quality at this point, semiconductors, which is why, you looked at, Biden potentially limiting the number of semiconductors. You looked at Trump limiting the number of chips, ultimately that China can get their hands on. They're looking for the higher end stuff. They are looking for, things that are going to power a DeepSeek type of model, whether it's DeepSeek or it's another company coming our way. What's interesting on the right hand of the slide, side of the slide, I should say, is the mining production by location. And I would even say when you look at that top bar where it says rare earths, a lot of actually what China does is they process rare earths, right? So they don't necessarily have all of the rare earths all over the globe. That's their monopoly is not a one of natural resources. It's more one of processing capabilities, right? And so you hear things like onshoring, nearshoring, or friendshoring. As it relates to rare earths, everything that I've seen, I've read, I definitely pay attention to this area, is that rare earths are our processing capability in the United States they're ramping it up. They have been ramping it up, but it's probably 2026 or 2027, which is really why China has us over a barrel a bit as it relates to these things that are so important for electronics, electric vehicles, and defense systems, right? So just something, again, to watch, to keep an eye on as there is a back and forth on the tariffs. You have, again, China less able to impact us by raising tariffs on us. This is where they're going after us. And there are some companies and the service economy that you see China focused on much more than specifically just tariffs. Again, because they're the workshop of the world. They're doing much more exporting than the United States does to China, but they're looking for other avenues. This is a big one. And this is, again, something that we'll continue to keep an eye on. If we jump to the next section, fixed income, really the first slide here talks about just the returns, right? So if we look at the 3-month returns, Federal Reserve continues to cut rates. They've taken a pause, I should say. What they have done is started to let the quantitative tightening slow, right? So they're starting to slow that, where they're holding steady on rates and have held steady on rates. Internationally, we see a little bit more of that. Fixed income in general has held up much better than the equity markets. If we do jump to the next slide, actually, we have, and this one is a little bit of an eye chart, sorry about that. And the upper left is really just negative returns in a diversified bond portfolio are rare, right? You see the big down in 2022, but generally speaking, you don't see a lot of negativity over the course of a year, and most certainly over the course of time as it relates to that. In the lower right-hand corner of this slide, it talks about the 5-year stock bond correlation. So, where in the past we've heard things like, oh, the 60-40 portfolio is dead, or asset allocation is dead. Really, the correlation between US stocks and bonds is still very low. You see it's positive in 2020 to 2024. Largely, that was driven by 2022, where, if you look at the S&P 500, it was down about 18%, 18.11%. And then if you looked in the bond market, it was down 13 and change percent. So that year, there was a big, very strong correlation. But overall, there's not much correlation. And overall, it is important to not only diversify your portfolio with bonds, but also diversify your portfolio within the bond category, right? Short, long, corporates, and different quality ratings. If we do jump to the next chart, I do like this chart again because there are intra-year declines, both in the equity markets and also the bond markets. So you'll see fluctuation for certain, but looking at it kind of at the worst, right? I mentioned 2022. If you look at 2022, the bottom was about 17%. It ended up about 13% down. Year to date, we're up about 3%. And, if you look at the negative of it had gone down all the way to kind of 1% there. If we do jump to the next slide, just the Fed and interest rates. So you see kind of in the middle below the box there, it talks about, the FOMC year-end estimates, the market expectations, the long-run projections. The trend is still down. The market expectation is it's not going to go down as much as we thought it was going to go down, which in part is due to tariffs and kind of the wait and see attitude that the Fed has to figure out where are we right now, where should we be, where do we want to get to, and how quickly do we want to do that. I mentioned earlier the quantitative tightening cycle, the Fed, as I said, they're slowing the pace of balance sheet drawdown, specifically on treasuries. They're still letting mortgage-backed securities draw down. But ultimately, if they slow down quantitative tightening, right, which usually acts opposite to a rate cut, right? So if they're tightening the money supply, that's slowing the economy down. If you're cutting interest rates, that's used as a stimulator. So if they're going to slow the tightening and ultimately do end up cutting rates, that could actually be something that will be a catalyst to push the economy and ideally the market forward. If we do jump to the next slide, we've seen this one before, really looking at the blue diamonds as really where the current fixed income yields are. Yield to worst over the past 10 years is really what the range is for the charcoal bar. So, in most categories, we still have pretty solid yields across the board as it relates to fixed income, certainly above the average over the last 10 years. And again, just kind of toward the top of the actual range. And this will be my last slide, the next slide here, the corporate bond spreads. So when you think of spreads tightening or spreads widening, it's really corporates versus treasuries, and relatively low still when we look at a historical perspective. Yields are still pretty tight, and the reward you get from going from something as safe as a treasury to a corporate bond, not a big difference there. As you do look out the yield curve, you're going further out in maturity, there is a steepening on the corporate side, right? So you get a little bit more of a reward if you go out further on corporates. If you look in the 25 to 30-year bond range, we're creeping up on 6%. If you're looking in the 5 to 6 range, you're at about 5%. So, is there really much juice to go out that long on the yield curve? I would say no. I don't think we're looking to say, hey, we should really lengthen our maturities. But, again, something to keep an eye on, look at. And as the yield curve moves and changes, we could see changes within the portfolio where we would adjust duration or average maturity of the ETFs and funds that we use. With that, I'll turn it back over to Jeff and Maddie for asset allocation.
All right, let's bring it home. All of our clients ask us, these presentations are great, but what does it mean for us and our portfolio? So that's really what this section focuses on. So first, we want to look at it from a broader scope. So if we look at asset class returns here, this is one of our favorite slides to show, but this one really highlights the importance of diversification. I think this first quarter has taught us that if anything is key, it's that maintaining a diversified portfolio is extremely important, as the Mag 7 has become the Lag 7. And each colored box here that you see represents the return of a major asset class in any given year, ranked from best to worst. And so two key major takeaways here. First, the performance Leadership changes constantly, right? And you can see that as you look at this heat map. Just to look at small cap stocks. So back in 2013 and 2016, they were the top performers, but in 2018 and 2022, they were at or near the bottom. And then if we look at commodities, REITs, and emerging markets, they also show large swings year to year. So trying to time these rotations is very difficult and very often counterproductive, which is why we don't do it. But we want to own all of these things. How much we own of them is also very important as we think about portfolio construction. So if we follow the black line with the white boxes, you will see the performance of a diversified 60% stock portfolio, 40% fixed income, labeled that asset allocation. So you can see it rarely tops the chart, but it also rarely ends up at the bottom. So it's also always about riding out that roller coaster of volatility that can be the market. So that consistency speaks to the value of a balanced approach that captures upside while maintaining the downside risk. We have this conversation a lot with our clients about, their portfolios, because they're often talking in terms of what is the S&P 500 done recently. But, we oftentimes change those conversations to, it's not about what your desired rate of return is. Everyone's desired rate of return is, double-digit returns year over year, but it has everything to do with your required rate of return, which speaks to that overall financial plan and making sure that you're in a portfolio that's really reflective of your situation. And as that situation changes, we want to make sure that your portfolio reflects that. So in 2024, we see the large cap and commodities leading, but as the year is, 2025 here, but obviously the year is far from over. And, chasing last year's winners is not a reliable strategy. We always, often talk about that as well. And certainly this slide is a visual reminder that discipline and diversification are absolutely essential in any long-term investment plan. And what does that look like, if we start with a certain type of portfolio being at that 60-40 allocation? What does it do if we don't rebalance? We are rebalancing, all of our clients' portfolios to maintain in line with our long-term asset allocation. And so this slide really highlights the approach to that and how it makes sure that your portfolio long-term fits with those goals. And if you don't rebalance, you can see the drift in a 60-40 portfolio over time. So at the start of 2019, the allocation was perfectly aligned with that 60-40 equities spread across US value, US growth, international, and fixed income. But as you can see, if you don't do anything with that portfolio by early 2025, and we're not talking that long of a time period here, that composition has shifted quite noticeably. So you'll notice that US growth has expanded from 25% to 35% of the portfolio, in large part thanks to its strong relative performance, especially in tech. Fixed income has shrunk from 40% down to 28%, even though it hasn't been actively reduced. That's just a result of the equity outperformance. And then US value and international equities have stayed relatively stable, but now make up a smaller slice of that overall equity mix. And this illustrates why regular rebalancing is so important. So left is untouched portfolios can gradually become overweight to the best performing asset class at that time, potentially increasing your risk and moving away from your original investment strategy. And as we've seen this year, if you haven't regularly rebalanced your portfolio, you've given away some of the gains that you've seen. So I think that this slide is a great reminder. Again, continuing on that theme, that discipline and diversification go hand in hand, especially after years of market momentum in specific sectors like growth stocks. And then if we look at diversification during growth and inflation shocks that we've seen in the past. And so this is a continuation of why diversification remains so critical, especially during times of economic stress or inflation surprises. We may see some of that in the future. On the left, we see how stocks and bonds have historically performed during recessions. Bonds are in blue, often act as, this is a continuation of the theme that Tom was really talking about, but bonds really often act as a cushion, delivering positive returns during nearly every recession, including a remarkable 38% during the early 80s. Stocks, on the other hand, are definitely more volatile, ranging from plus 13% in 1980 to down 37% in the Great Financial Crisis. So really a pattern that reinforces the role that stocks and bonds play as risk offsets during periods of declining growth. And then on the right-hand side, you see that during the 2022 inflation spike, and Tom had alluded to this, when he was talking about bonds, both stocks and bonds fell. So stocks were down more, they were down 19%, bonds were down 13%. And this is one of those rare instances where traditional diversification didn't work as expected in the past due to rapidly rising rates on bonds. So that one bright spot was alternatives during that time, which is shown in gray, that returned a positive 6%. Again, highlighting the importance of including other asset classes. And that's something that, we've been incorporating more and more into our discussions with clients. We had a whole webinar dedicated to this specifically. So the key message here is no one asset class works in every environment. True diversification across stocks, bonds, alternatives can help manage risk, certainly more effectively through a wider range of economic conditions. And, as we have all alluded to in this presentation, there are opportunities when volatility arises. Jeff said it's a feature of the stock market, not a bug in the system. So as we, see that opportunity arise, something that we take very seriously in taxable accounts is tax efficient investing. An area of opportunity that we've seen right now is tax loss harvesting. And that can improve after-tax returns by using investment losses strategically and carrying forward that into years in which you are going to have some gains. And so if we look at this example here, it's sort of an eye chart, but an investor has $20,000 in capital gains from investment A, which would typically result in a $7,000 tax bill, assuming a 35% marginal rate. But the investor also has a $25,000 capital loss from investment B. So by applying that loss to offset the $20,000 gain, they eliminate the tax bill entirely, saving that $7,000 in taxes. The remaining $5,000 in unused losses can be further applied to reduce $3,000 in ordinary income in the current year. That final $2,000 can be carried forward to offset future gains or income. And the investor saves, a little bit over $8,000 through tax smart planning. And, I use this example specifically because it came up in a client discussion, but it doesn't always have to be offsetting gains from an investment portfolio. A lot of our clients are very dynamic. They have a lot going on. And so, we need to make sure that we understand your tax specifically, because if you're selling a property at a gain, as the real estate market has really exploded over these past few years, we may look to offset that gain with capital losses through your investment portfolio. Hence, being able to speak to that broader financial plan, making sure that you are holistically in a good place, not just looking at your investments. So great example of how proactive tax management can really add some real value here, especially in volatile markets. And that's something that we implement strategically throughout the year. And so we wanted to end on, a really good note here. We showed this slide before, but I think it's an important one to continue to refer back to. Time diversification, volatility of returns. So this really highlights the importance of staying invested, being diversified, maintaining a long-term mindset that all of our clients have. We are not investing for, the next 1 to 2 years. A lot of our clients are investing, not only to get them to a specific time period, but also getting them through that specific time period. And a lot of our clients' assets are going to live, on. And so we want to make sure that that's always something that's incorporated in our discussions. But on the left, we see the range of 1-year returns for stocks and bonds, and that 60-40 portfolio since 1950. You can see that stocks have had years with returns as high as 52%, as low as 37%. Bonds and blended portfolios show much narrower ranges, but the message is pretty clear here. So volatility is highest over short time frames, and we really want to look, as we move to the right over the 5-year, 10-year, and 20-year rolling periods, the range of outcome narrows considerably. By the time you get to that 20 years, the worst rolling period for a diversified portfolio was still positive. So certainly a powerful argument for patience. And the table on the right hand corner reinforces the power of compounding. So $100,000 invested in stocks over 20 years grew to $900,000. The same amount in a 60-40 portfolio grew to $600,000. Bonds alone reached $276,000. And so again, takeaway here is simple, but I think it's essential. Your longer term time horizon, the longer your time horizon, the more predictable your investing outcome becomes, and the more powerful diversification can be. So again, this is exactly why we encourage clients to stay disciplined, make sure you're on the right asset allocation, no matter what market cycle that we may be in. And with that, I will hand it back to Jeff to close us out here.
Great. Thanks, Maddie. Thanks, Tom. Fortunate to have a great team, and I really I want to just acknowledge the work that was put together here with the various slides. And so, in closing, I want to just hit on a handful of points, and then I do want to come back to something that's critically important at the end as well. So, as we think about Q2, where here we are, 3 weeks in, it's all about tariffs, right? I get that. It's you're getting Sports Center market updates. But this too shall pass, and I don't mean that in a dismissive way. I mean it that, like, we will have these periods of episodic volatility driven by a cause that's outside your control, and so you want to really get back to the things that you can control, whether it's taxes, it's fees, it's the allocation, right? So again, the things we're paying close attention to, the tariffs, margins, and how they impact corporate profitability. If we see companies or sectors which are less exposed to the impact of tariffs, we'll see more of that in the portfolio. And to be honest with you, year-to-date utilities and consumer staples, they're actually in the black still, right? Why? They're, again, your PSE&G bill, your Con Ed, your AES utility bill, not a lot of tariff impact there as they send megawatts or kilowatt hours through your wires. I'm not ready to fade the U.S. exceptionalism trade. I know that there's the talk about foreigners selling U.S. assets, bringing back onshore, back to their local markets. I think that makes sense at the margin if you're under indexed to overseas exposure. But the truth is, like, we still have some of the most dynamic, resilient, adaptive, businesses out there, whether it's technology, which obviously gets a lot of attention, but in a host of other sectors. So again, I don't think it's a time we want to be, ratcheting down our exposure to this wonderful engine. The early phase of 2025 was interesting as I watched it. In overseas stocks were doing really well, and you saw a little bit of a drift in U.S. stocks. But as the worries about the recession picked up, and President Trump acknowledging that and hearing that from others like Jamie Dimon in the world, you started to see overseas stocks wobble a little bit, right? There's this view out there that we are the elephant in the room, and I think that still is very much the case. So if you're in a position where, Maddie, sorry, just leave the slide up for me. You're with a view of the world getting weird and impact the U.S., it's going to spill over outside our borders. We've heard a little bit of the Mar-a-Lago Accord, kind of something similar to the Plaza Accord from the mid '80s, which was a time when the U.S. dollar was overvalued, and the Japanese at the time, kind of Exhibit A, were instrumental in devaluing their currency. And so, we look at dollar weakness as both a good and a bad thing. It makes us perhaps a little bit more attractive from a global trade perspective if we are, in fact, likely to manufacture more. Again, call me a bit skeptical on that. But, a weaker dollar can translate to more inflation. So I don't know how good it is for us to have a materially weaker dollar. We have seen the dollar, weaken pretty significantly against the euro and some of the other developed market currencies this year. Again, I highlighted in my point of the discussion, valuations, right? Like they matter a lot. They always do. The fact is today stocks are cheaper than they were in January. I think I'd love to be in a position where I say like, these are, generational buying opportunities. We haven't seen quite that big of a pullback, but I think if you're out 3, 5, 10 years, the fact you can buy things today at 19 times feels a lot better than 22 times. I think if earnings can hold up, and that's my expectation, we're probably at a pretty interesting level, maybe closer to a floor. If earnings do roll over, stocks probably have a little bit further to come down here. Not a lot more. I'm not expecting anything like a pandemic or financial crisis, but at the same time, we have to be realistic. The comments relative to the Fed are important, right? Powell spoke yesterday in Chicago and basically said the tariffs have painted them in a corner where businesses might have to lay people off to control their operating expenses, which is bad for the dual mandate, specifically around full employment. But at the same time, if higher prices do result in whether it's a stair step or more sustainable price increase dynamic, that kind of flies in the face of the reason with they're fighting the inflation mandate, right? Price stability. So I'm of the camp that if we walk back the tariffs, the Fed will start easing. I think that we saw that with the inflation data, both in the slides today, but even the stuff that's come up post the data here. Again, don't be surprised if again, we do see the negotiations are positive and the tariff stuff get kicked out. Powell wraps up his term in May of next year, and I think he wants to see a soft landing. There's a little bit of a question relative to this tit for tat with China is who has more leverage, and you could argue that we're both dealing from a position of strength and both dealing from a position of weakness. One of the bull cases for China early in the year was that, after pushing on the monetary stimulus tool a couple times last year, they really had to shift to fiscal. That would potentially be the case if they stop manufacturing altogether, because they'll have very little place to help with on the employment side. Again, let's be realistic. That's not happening, right? They are not only an important exporter, but they are exporting deflation to the world. So again, China is very much worth watching. I think that you'll see stimulus later this year than perhaps what was initially hoped for, but better late than never. And two closing thoughts relative to the tariffs and acknowledging the firsthand impact. The Yale Budget Lab has estimated that for a family of 4, the costs would increase by $2,600 to about $4,500. So we don't want to be insensitive. I know that probably doesn't impact most of the people here listening to the call, but at the same time, it's safe to say that if we saw that really feed its way into the system, you could see a more challenging environment for the macro economy here in the U.S. So we're going to watch that really closely, obviously. We're hoping that we can avert a self-made crisis, but again, these things happen from time to time. So lastly, as I kind of hinted to at the beginning, every one of us have an open calendar, right? You see in our emails, oftentimes just direct access to our Calendly link. So if you have any concerns, I know I've talked to a handful of you a few times over the last few weeks, please book some time, put it on a calendar. We're happy to hold your hand. We're happy to kind of go through what we're doing and why we're doing it with you. We're grateful for the opportunity to serve you, especially in volatile times. And again, thank you for taking the time today. I hope you had a good holiday week for those of you celebrated Passover, and for those celebrating Easter. Thank you again for the time. Take care.